What double taxation simply means is that income of a company or income of an individual is subjected to tax in different countries. Example, you are a consultant or a professional. You travel to abroad to render a service. You will pay for the service. So when they pay you for the service in foreign country, this on that income, which may be one-off tax, withholding tax. Please let us mute our audio, please, so that we can enjoy the class. So when you now you travel back to Nigeria, which is your country of origin, that income that you bring from abroad to Nigeria is going to be subjected to tax again in Nigeria. The tax authority in Nigeria too will collect tax on such income again. In that case, that type of income has been subjected to what is called double taxation. So, based on my divination, double taxation is a situation whereby income or capital of a taxpayer is being subjected to tax more than one by more than one tax authority in different countries. Instead of using different countries, some people may use different tax jurisdiction. In tax country, we call them jurisdiction. Nigeria is a tax jurisdiction on their own. UK is a tax jurisdiction. So double taxation simply means one income received by a company or a taxpayer individual subjected to tax more than once by different country. Double taxation is different from multiple taxation. Multiple taxation simply means an income is subjected to a tax by different. Multiple taxation simply means a situation whereby different tiers of government, different level of government impose tax on the same income received by taxpayer. What that one means is that federal government collect tax on the same income, state government collect tax on the same income, local government collect tax on the same income. That is multiple taxation. How do you differentiate multiple taxation with double taxation? Multiple taxation occur within a country. When we talk about multiple taxation, it's within Nigeria. You pay tax more than once on your income within Nigeria. But when you pay tax to different tax authority in different country, that one is called double taxation. That one is called what? Double taxation. Now, let's look at forms of double taxation. There are two forms of double taxation. We have juridical double taxation and economic double taxation. We have juridical double taxation and what? Economic double taxation. What do we mean by juridical double taxation? Juridical double taxation simply means a situation where same income is taxed twice in different countries in the hand of the same taxpayer. A situation where same income is taxed twice in different countries in the hand of what? The same taxpayer. Mr. Dr. Ben is a medical consultant. He went to abroad to perform a surgery. He was paid for the service he rendered in abroad. Since Dr. Ben is a resident of Nigeria, when they pay him in abroad for the surgeon service he provided, they will deduct withholding tax from such income. When Dr. Ben moved back to Nigeria, that income he received in abroad from surgery he will also pay tax on it, personal income tax on it again in Nigeria. That type of double taxation is called juridical double taxation. That means income is subjected to tax more than once in different countries in the hand of the same what? Taxpayer. But in the case of economic double taxation simply means a situation whereby same income is subjected to tax more than once or twice in the hand of two different taxpayers. In the hand of what? Two different taxpayers. An income of $200 million, $200 is subjected to tax more than once in country A and in country B. But when it is subjected to tax in the country A, it is in the hand of Mr. Company ABC Limited. But when it is subjected to tax in country B, that income have moved from hand of Company ABC Limited, to the hand of Mr. Adebayo. That means that particular income is subjected to tax more than once or twice in the hand of two different taxpayers. Example, if a company pay dividend, a foreign company pay dividend to a citizen of Nigeria, somebody residing in Nigeria. Do you understand? That dividend paid by that foreign company, in the hand of the foreign company, they will have paid tax on that dividend. When it moves to the hand of the individual that receive it in Nigeria, Nigeria government will ask him to come and pay tax. That one is what? Economic double taxation. Now, let's look at concept of double taxation agreements. Double taxation agreement is otherwise called tax treaty. Double taxation agreement is otherwise called tax treaty. Tax treaty is an agreement between two or more countries. It is an agreement between two or more countries for the avoidance of double taxation of income and capital. An agreement between two or more countries for the avoidance of double taxation of income and capital. When two countries, they sign an agreement that we will not engage in double taxation on any income coming from our country. Example, maybe Nigeria and UK, they sign a double taxation agreement. What that one means is that any income that has been subjected to tax in UK, if the income is going to Nigeria, it may not be subjected to tax again, or it will be subjected to tax at a discounted rate. If an income has been subjected to tax in Nigeria, if the income is going to UK, based on the agreement, it depends on the content of the agreement, it may not be subjected to tax again in UK, or it will be subjected to tax at the lower rate. So that is double taxation agreement. When two or more countries sign an agreement together in order to avoid or reduce double taxation of income and capital, that is double taxation agreement. In some textbook, you will see double taxation agreement as what is called tax treaty. Tax what? Treaty. And double taxation agreements can be divided into two. We have unilateral agreements and multilateral agreements. Unilateral agreements and multilateral agreement. Those are the two types of double taxation agreements. Unilateral agreement simply means an agreement, a double taxation agreement between two countries, country A and B. But in the case of multilateral agreements, it is an agreement, it's a double taxation agreement between more than two countries. Example of multilateral agreement, when West Africa sign an agreement between themselves that they want to reduce trade barrier within the West Africa. Example of multilateral agreement is called AfCFTA, Africa Continental Trade Agreement. It's a multilateral agreement because it involves more than two countries. But an agreement that is just that consists of just only two countries, that one is a unilateral agreement. Now, let's look at objective of double taxation agreement. Why will a country enter into a double taxation agreement? Why? Why? Number one objective, avoidance of double taxation of income. They want to avoid double tax on some of the income. Another objective, grant of tax treaty benefits. They want to ensure that trading between the two countries, if you are a country, you have branch between the two countries that signed the agreement, you may have some tax benefits. Prevention of fiscal evasion and avoidance. They want to prevent tax evasion and avoidance. Cooperation on tax matter is another objective. Cooperation on tax matter. Exchange of information. They want to exchange information among themselves. You know, double taxation is under international taxation. It's one of the international taxation policy. In our advanced tax syllabus, there are some topics we regard those topics as an international taxation issue. One of them is double taxation. Second one is taxation of non-residents. Third one is transfer pricing. Fourth one is tax haven. Fifth one is base erosion profit shifting. Seventh one is economic integration and regional trade block. Eighth one is tin capitalization. All these topics I mentioned, they are under international tax. International tax. And in our exam, at least 25 mark question will be centered on the area of what? International tax. Let me repeat it again. Double taxation is one of the international tax. Taxation of non-resident is one of the international tax. Transfer pricing is one of the international tax. Tax haven is one of the international tax. Base erosion profit shifting. Economic integration and trade blocks. And we have the last one called tin capitalization. All these are international tax issues. So
you said the last one. The last one you mentioned.
Tin. THIN, tin capitalization. THIN.
Okay.
So, exchange of information is very key in international tax. Tax authority, country A, tax authority in country A and country B, they normally exchange information about their taxpayer. You know, some companies, they may shift their profit from one country to another. But since there is also exchange of information, tax authority in one country may give another tax authority about
What's happening
the
on the
income.
audio? So the audio is cracking. The
What
audio
did
is
you say?
cracking. The audio is cracking, seriously. The audio.
Seriously?
Yeah. Am I the only one hearing it, guys?
Okay.
Please.
And it's clear. Is it clear now?
Yeah,
It's clear now. It's clear now.
Okay. Now, we are in objective of double taxation agreement. Exchange of information. Another objective of double taxation agreement is called non-discrimination. We can call this one non-discrimination between taxpayer. We should not discriminate among the taxpayer. We should treat the taxpayer equal. Let's try to treat the taxpayer equal. Non-discrimination between the taxpayer. All these are objective of double taxation. Now, the next heading, let's look at the list of countries.
Sorry, sir. Hello, sir.
Yes.
Yeah, good evening, sir. Please, could you help recount the list of the international tax? It was breaking then. I couldn't really get all.
Okay. One of them is the topic we are doing now, double taxation relief. Number 2, taxation of non-resident company. Taxation of non-resident company. Number 3, transfer pricing. Number 4, tax haven. Haven, HAVEN. Number 5, base erosion profit shifting, BEPS. The abbreviation is BEPS, based erosion profit shifting. Number 7, economic integration and regional trade bloc. Under economic integration and regional trade bloc, we'll be looking at Africa Continental Trade Agreement, objective of Africa Continental Trade Agreement. After that one, the last one is tin capitalization. So now let's look at the list of countries that signed double taxation agreement with Nigeria. We have so many countries that signed double taxation agreement with Nigeria, but some of them include United Kingdom, France, Belgium, China, South Africa, Canada, Netherlands, Romania, Pakistan, Italy, Spain, Philippines. There are so many. In one diet, examiner want to give bonus mark, 5 mark, list 10 countries in which Nigeria signed double taxation agreement with, 5 mark. It is a bonus mark. Do we understand? So, ladies and gentlemen, we should know at least 10 countries in which Nigeria signed double taxation agreement. Please, let's know 10. Now, double taxation agreement with UK. And now, I want to let you know that if Nigeria signed double taxation agreement with any country, that agreement will have commencement dates and it will have termination dates. The agreement can be 5 years agreement, it can be 2 years agreement, it can be 3 years agreement. Do you understand? In the content of the agreement, they will state when the agreement will commence and when is it going to terminate it. Do you understand? If the agreement is already terminated, that agreement is no more effective again. They may decide to resign another agreement between the two countries. Do you understand? But now, mind you, the double taxation agreement Nigeria signed with all these countries, the content of the agreement is different from country to country. The content of double taxation agreement Nigeria signed with UK will be different from the one of France. You understand? It will be different. So that is that. Now,
So sorry, sir.
let's look.
Sorry, sir.
Okay.
Hello, sir. Are we now saying
I
that
can
these
hear you.
countries listed? Okay, are we now saying that these countries listed are some of the countries that Nigeria normally how do I put it now? For
As
every
at
time the
present.
contract expires, okay, they normally do it over and over again.
No. As I'm talking to you presently,
Okay.
part of the agreement, double taxation agreement that is still effective, the list of countries that is among them is what I listed. Do you understand?
Yes, sir.
Presently, the list of countries that Nigeria still has double taxation agreement with, which is still effective, some of those countries is what I listed. Do we understand?
Yes, sir.
Now, let's look at features of double taxation agreement. If agreement, one features of double taxation agreement is the name of the two countries involved in the agreement. The name of what? The two countries involved in the agreement. They will state double taxation agreement between Nigeria and UK. Those are the two countries. Number two, content or features of double taxation agreement. The rate of tax applicable in the country. In the agreement, they will state in Nigeria, our company income tax rate can either be 20% or 30%. In UK, their company income tax rate can either be, you understand, it depends. Our education tax rate is 3%. They will state. Another one, another content. Transaction on which double taxation relief is applicable. They will mention that these are the kind of transaction that double taxation relief will be applicable on. Another content, arrangement for exchange of information. They will state it in the content that the two countries will be exchanging information relating to their taxpayer so that they will avoid tax evasion. It's not only to avoid double taxation. There are some people, they want to avoid tax. Tax authority duty about such country that move the investment to okay. Another context, the appeal procedure in the event of a dispute. The appeal what? Procedure in the event of a dispute. The date of coming into force of the agreement and the possible termination date. That means the date in which the agreement will start and the date in which the agreement will end. So all these are the contents of double taxation agreement. The method by which the effect of double taxation is eliminated. So all these are the content of double taxation agreement. So please, let's know at least 7 content or 5 content of double taxation agreement. Please, let's take note of that. Now, let's look at income exempted from double taxation. There are some income, if you receive it in abroad, you take it to Nigeria. Once that income has been taxed in other country, if you move it to Nigeria, that income will not be taxed again. Those are the income we want to mention now. What are those income exempted from double taxation? Number 1, remuneration of a professor. Remuneration of what? A professor or teacher who is resident for not more than 2 years in the country for the purpose of teaching. Maybe you're a professor, you are into academics. You now travel to abroad for sabbatical leave. You want to go and lecture in a university in abroad for your sabbatical leave. During that your sabbatical leave, when you earn remuneration in abroad, because you'll be teaching in a university in abroad, during that period, when you earn any remuneration, such remuneration will not be subjected to double taxation if you don't stay in that country for more than 2 years. But if you stay in more than 2 years, such income will be subjected to double taxation. Government pension are exempted.
Hello, sir. Hello, sir.
Yes.
Sorry, sir.
The line is breaking, sir.
The tax on professor. Can you hear me, sir? Hello, sir.
I can hear you.
Yeah,
I can hear you.
Yeah, the tax for the professors. Which of the countries is going to be taxed? Is it your permanent resident country or the country you went to do the sabbatical leave where you engaged in?
What we are saying is, when you are in that sabbatical leave, you understand?
Yes,
in that country that you travel to go and do your sabbatical leave, they will pay you wages, Abi, during the lecture, because you'll be engaged in lecturing in a university, in a foreign university. That country, they will, from the wages that they pay you, they will collect tax. When you take the income back to Nigeria, that income you earn from your sabbatical leave, when you take it back to Nigeria, Nigeria government will not collect tax again.
Okay. Right.
Do you understand?
Understood. Yes, sir. Thank you very much.
The line is not breaking, madam. Hope you can hear me clear and loud.
It's better now, sir.
Okay. Another income exempted from double taxation, government pension. Government pension are exempted from double taxations too. Maybe before you relocated back to Nigeria, you have worked in United States of America Army for like 18 years. After the 18 years, you now decide that you will resign or retire. You now move back to Nigeria. See, when you are now in Nigeria, they are still paying you pension from other country. That pension, when you receive it in Nigeria, Nigeria government will not collect tax on it. Another one, aircraft or airline and shipping profit are exempted 100%. Aircraft and shipping profit are exempted 100%. When an airline company or shipping company, they make a profit in another country, they now bring the profit to Nigeria. That profit will be exempted from tax. Why? Who can tell me why? Because airline and shipping company, the way we tax them is different from any other country, any other company. They are under taxation of what? Who can remind me? Airline and
Specialized
shipping
business.
company.
Specialized business.
Abi? And there are steps in which we adopt in computing their tax. Abi? So their profit is not subjected to double taxation. Another one, dividend paid by UK, United Kingdom company to a Nigeria resident who has no permanent establishment in United Kingdom. Somebody that is not residing in United Kingdom is a Nigerian citizen, is residing in Nigeria. He now invests in a shares in a foreign company. Such foreign company is now paying dividend to him. Such dividend, if you receive the dividend, Nigeria government will not collect tax on the dividend again, because that dividend will have been taxed in abroad. Another one, payment to a student or apprentice during his full-time education or training in Nigeria. A foreign student that is not a Nigerian citizen came to Nigeria to come and engage in an education or an apprentice. During that period, if he earn an income, Nigeria government cannot collect tax from it. So all these are the income that are exempted from tax. Now, method of elimination of double taxation. If you want to eliminate double taxation, if you want to avoid payment of double taxation, what are the methods in which we use to avoid payment of double taxation? There are two methods. It's either exemption method or credit method. There are two methods of elimination of double taxation: exemption method or credit method. Exemption method simply means it's either that income is exempted from double taxation. Do you understand? That income, they will have exempted from double taxation. It has been stated clearly in the tax law that such income will be exempted from double taxation, that it can only be taxed in one country. It will not be taxed in another country if it has been taxed in one country. That is exemption method. For the credit method, if that income has been taxed in other country If you want to be taxed in another country, before that income will be subjected to tax in another country, we have to give them some relief. That relief is what is called double taxation relief. Credit method has to deal with what is called double taxation relief. Before we subject an income that has been subjected to tax in another country, example, an income has been subjected to tax in country A. You now bring the income to country B. Before country B will subject it to tax, they will give him some credits. Example, assuming country B, when they calculate the tax that they're supposed to collect on such income, assuming that tax is 200,000, they will not say, instead of you paying 200,000, we will give you some credit or relief. We may give you relief of 60,000. So you will pay 140,000. That relief is what is called credit method and otherwise known as double taxation relief. So that is on credit method. Now, for the sake of time, let's look at computation of double taxation relief. How do we compute that credit method? That credit method you mentioned, how do we compute it? Computation of double taxation relief. As we all know, double taxation relief is a credit or allowance available to an income that has been subjected to tax outside the country. Double taxation relief is a credit or allowance available to an income that has been subjected to tax outside the country. Before that income will be subjected to tax in Nigeria, we are going to give them some relief or credits. Instead of the income to subjected to tax of 200,000, we may give him credit of 60,000. It will now be subjected to tax of 140,000.
Hello, sir.
Yes.
Okay, so I just want to ask a question, just to be clear, right? So I
Yes,
just
sir.
want to understand. Let's say someone has the income in dispute now is let's say ₦1,000,000, right? And so the tax on it in the source country. So the tax on it in the source country is say 10%, that's like 100,000, right? But in the country of residence, the tax rate, let's say the tax rate is 20%, right? So that should be like 200,000 naira. So are we saying for this credit method, are we saying that a relief of 100,000 that was paid as tax in the source country will be granted against the 200,000 in the residence country? So the taxpayer would now have to pay the balance of 100,000. I'm just trying to put
No,
figures, it's just to understand it. Okay.
no, that is not what we are saying.
Okay.
That is not what we are saying. Like you explained, you said that income has been subjected to tax 100,000 in one country, Abi?
Yes.
And in the other country, which is the destination country,
Yes.
they want to subject it to tax, it's supposed to pay 200,000 tax.
Yes.
The credit note we are saying is, they will say, okay, since they have paid 100,000 in the source country, do you understand?
Yes.
And you're supposed to pay 200,000 a year. Because you have paid 100,000 in the source country, we will give you some discount. The discount we are going to give you, we may give you discount of 40,000. Pay 160.
Okay, that's what I wanted to get. So it's possible that The credit might not be 100% of the tax that was paid.
The profit, the credit will not be 100%.
Okay, that's what I wanted to get. Okay.
The profit, the credit, sorry, will not be 100%. Please note that. So, method of computation of double taxation relief. How do we compute double taxation relief? Number one, for resident company. For what? Resident company. What is a resident company? A resident company is a company that is incorporated or registered under Corporate Affairs Commission in Nigeria. Any country, any company that is registered, incorporated in Nigeria, we call them resident company. Another name for resident company, we may call them Nigeria company. Nigeria what? Company. A company that is incorporated or registered under Corporate Affairs Commission in Nigeria. It is called resident company. That means for a resident company, profit derived by a resident company in Nigeria will be subjected to tax in Nigeria. Do we understand? Do we understand? Hello?
Yes, sir. We understand.
A resident company, if you derive profit in Nigeria, it will be subjected to tax in Nigeria. How will double taxation affect a resident company, company that is incorporated in Nigeria, registered in Nigeria, and is doing business in Nigeria? A resident company may decide to have a branch. A resident company may decide to have what? A branch. In where? In another country. Mark my word. Branch, not a subsidiary. In double taxation, subsidiary is different from branch. Example, ABC Nigeria Limited is a resident company because it is incorporated and registered in Nigeria. Any profit made by ABC in Nigeria will be subjected to tax in Nigeria. We all know that, Abi. However, ABC decide to expand its operation. It now go and establish a branch in another country. A branch. That branch ABC established in another country. The profit made by the branch, the country where the branch is located, they will collect tax on that profit. Again, Nigeria, where the head office of ABC is located, they will also collect tax on the profit of the branch. But before collecting tax on the profit of the branch, we give the branch profit some relief, some credit called double taxation relief. We give the branch profit some relief or credit called what? Double taxation relief. So, method of computation of double taxation relief, we want to look at, the first one we want to look is, how do we compute a double taxation relief for a resident company, a Nigeria company that has a branch in where? In another country. That profit of his branch will be subjected to tax in Nigeria, despite it has already been subjected to tax where the branch is located. Now, how do we compute double taxation relief for a resident company? There are two ways. Number one is when there is an agreement between the two countries. When there is an agreement between the two countries, the double taxation relief rate shall be the rate stated in the agreement. What that one means is that ABC Nigeria Limited is located in Nigeria. It now has a branch in UK. It has a branch in UK. Assuming Nigeria Tax Authority and UK Tax Authority sign a double taxation agreement. So if you want to compute double taxation relief for the company, we are going to use the rate stated in that agreement. However, when there is no agreement, we are going to compute a rate first. We need to compute a rate. That rate is called Commonwealth rate. When there is no agreement, we compute a rate. That rate is called Commonwealth rate. Commonwealth rate. Commonwealth rate. That will be that rate. It is called Commonwealth rate. When we get the Commonwealth rate, we compare it with half of Nigeria tax rates. If Commonwealth rate is higher than half of Nigeria tax rate, the double taxation relief rate shall be Commonwealth rate. But if half of Nigeria tax rate is greater than Commonwealth rate, the double taxation relief rate shall be half of Nigeria tax rates. How do we compute Commonwealth rate? Under resident company. How do we compute Commonwealth rate? Under resident company. Foreign tax paid. Foreign tax paid. All over total profit from their foreign branch times 100. How we compute Commonwealth rate for a resident company? Foreign tax paid all over total profit from their foreign branch or foreign business. Once we get our Commonwealth rate, we compare it with half of Nigeria tax rate. The higher between the two is what we are going to use as double taxation relief rate. Now, method 2, under method of computing double taxation relief. Method 2 is for a non-resident company. A non-what? A non-resident company. A non-resident company. What is a non-resident company? A company that is not registered or incorporated in Nigeria. but that company derive income or profit in Nigeria. A non-resident company is a company that is not registered or incorporated in Nigeria, but derive profit in where? In Nigeria. So if we want to compute the double taxation relief in the case of non-resident company, we compare Commonwealth rates with Nigeria tax rate. We compare Commonwealth rates with Nigeria tax rates. When Commonwealth rate is lower than Nigeria tax rate, the double taxation relief rate shall be half of Commonwealth rate. Let me repeat it again. When Commonwealth rate is greater than Nigeria tax rate, the double taxation relief rate shall be what? Half of, well, sorry, when Commonwealth rate is less than Nigeria tax rate, the double taxation relief rate shall be half of Commonwealth rate. But when Commonwealth rate is greater than Nigeria tax rate, the double taxation relief rate will be Nigeria tax rate minus half of Commonwealth rate. Nigeria tax rate minus half of Commonwealth rate. This is for non-resident company. Now, number 3 method of computing double taxation relief rate. That number 3 is for resident and non-resident individual. That number 3 is for what? Resident individual and what? Resident individual. Who is a resident individual? Who is a resident individual? Who can tell me who is a resident individual? A resident individual. Who can explain?
A person who lives and earns in Nigeria.
So, the residents individual.
Okay, I can hear you.
Can you hear me, sir?
I can hear you.
Okay, somebody that has a permanent place available for employment.
I can't hear you clearly. Repeat
Okay,
it again.
Somebody that has a permanent place that is available for basic use in any part of Nigeria. Somebody that's been in Nigeria.
No. A resident individual is an individual that domicile or reside in Nigeria for more than 183 days.
There are 3 explanations.
A resident individual is an individual that domicile in Nigeria for more than how many days? 183 days. And a Nigeria citizen serving as a diplomat or working in a Nigeria embassy in another country. There are 2 points under resident individual. Somebody that resides in Nigeria for more than 183 days. Even if you're a foreigner, you now come to Nigeria. If you have stayed in Nigeria for more than 183 days, according to the law, you have become what? Nigeria resident. Another name for resident individual is called Nigeria resident. When you have stayed in Nigeria for more than 183 days, maybe you are not a citizen of Nigeria by birth. You just come to Nigeria to do business. You are an expatriate. If you stay in Nigeria for more than 183 days, you have become Nigeria resident. Second person that we regard as Nigeria resident, they are Nigeria citizens that are working in, or they are serving as a diplomat in another country. Nigeria citizens that are representing Nigeria as a diplomat in another country. Maybe you are working under Ministry of Foreign Affairs. They now transfer you to China to work in Nigeria embassy in China. While working in Nigeria embassy in China, you are still a Nigeria resident. On your salary, the tax due on your salary will still be collected by Nigeria government, not Chinese government. Because you are going to that China to represent Nigeria. That is resident individual. What about non-resident individual? Non-resident individual. Non-resident individual is a person that does not domicile in Nigeria for more than 183 days, half of a year. Somebody that does not domicile or stay in Nigeria for more than 183 days. But we use but in the case. But that person derive what? Income or profit from where? From Nigeria. So what that one means is that a non-resident individual, which otherwise called non-Nigeria resident, is a person that does not domicile in Nigeria for more than 183 days, but derive income or profit in where? In Nigeria. That is the first part of definition of non-resident individual. And I did not put the second one. And a foreign citizen serving as a diplomat in Nigeria. And what? A foreign citizen serving as what? A diplomat in Nigeria. What that one means is that those foreigners that are working in an embassy, maybe they are working in American embassy, UK embassy, they are citizens of UK. They are now working in UK embassy. They are non-Nigeria residents though, despite working in Nigeria. So please, let's know that. In the case of resident individual and non-resident individual, how do we compute their double taxation relief? How do we compute their double taxation relief? The double taxation relief for resident individual and non-resident individual shall be the lower of Nigeria tax rates and Commonwealth rates. The lower of what? Nigeria tax rates and Commonwealth rates. The one that is lower among the two will be the double tax relief rate. The one that is lower among the two will be what? Double tax relief rate. So let's look at the question. Let's look at the question. Let's look at the question. Question 2. Question 2. Question 2. Adesua Limited was registered in where? 2016. In 2018, it expanded to what? To Ghana, to tap into business opportunity in that country. The director have heard about double taxation agreements. Please try to mute your audio. The director have heard about of double taxation agreement with relevant benefits. Please, you are distracting us. Through the company have never been a benefit, though the company have never been a beneficiary. Below is the summary of income statement for the year ended 31st December 2023. Gross professional fee, other income, expenses, deal execution, office rent, depreciation, loss on sale of fixed assets, foreign exchange loss provision, other operating expenses. Additional info. The sum of 2.4 million naira was paid to what? Ghana Tax Authority for the year after claiming capital allowance of how much? 5.1 million naira. The capital allowance claimable in Nigeria was 8.8 million naira. Other income of 1.2 is profit of sale of non-current assets. While 800,000 is gain from disposal of what? Shares. Required as a professional tax practitioner. Explain what is meant by double taxation relief. B. Compute double taxation credit claimable by the company, considering that there is no agreement with Ghana. C. Compute the income tax payable after the credit. Ladies and gentlemen, Adesua Limited, Adesua Idris Limited. What type of company is Adesua Limited? Out of the three methods of computing double taxation I mentioned above, what type of company is Adesua? Is it a resident company or non-resident company or resident individual or non-resident and non-resident individual. What?
It's a resident company.
It's a resident company. It's a Nigeria company. He now has a branch in where? He has a branch in where?
Ghana.
In where? In Ghana.
Ghana.
Which of the profits will suffer double taxation?
The
Profit
profit
of
from
Ghana.
Ghana.
Is it
Profit from Ghana.
profit of Ghana operation? Because Ghana tax authority will collect tax on it. Nigeria tax authority want to collect tax on it. So let's go to the solution. First, we are asked to define double taxation relief. Double taxation relief is a credit available in Nigeria tax law on income that has suffered what? Foreign tax outside Nigeria and now brought into what? Nigeria. The objective is to ensure that the income is liable to tax in Nigeria, liable to Nigeria tax brought into Nigeria from other countries, does not suffer tax twice. Now, the solution of B and C. We will first of all compute adjusted profit for both Nigeria operation and Ghana operation. Look at how we arrange them. Nigeria operation, Ghana operation, total. We will start. I want to get the adjusted profit for both country operation. I will start with net profit. In my net profit, I will add what? Disallowable expenses. So, ladies and gentlemen, out of all these expenses mentioned above, which one is disallowed among them? Out of all these expenses, which one is disallowed?
Depreciation.
Depreciation is disallowed. Loss on sale of fixed assets too is disallowed. When you sell fixed assets, you make a loss, is disallowed. Profit on sale of fixed asset income, is it taxable or non-taxable?
It's allowable.
Is non-taxable income. When you make profit on sale of fixed asset, you are not going to pay income tax on it because that profit you make on sale of fixed asset will have been subjected to another type of tax called what?
Capital gain tax.
Capital gain tax.
Thank you very much. So when you sell fixed asset, if you make a profit, the profit is not subjected to tax under company income tax and personal income tax. If you make a loss, the loss is a disallowable expenses. Number 3 disallowable expenses I have in this question is what? Foreign exchange loss what? Provision. Foreign exchange loss what? Provision. When you make in tax, if you see it in an expenses of a tax, provision for salaries and wages as an expenses, you are not going to allow it because that word provision for salaries and wages, it means they just provide for it. They have not do what? Pay it. In tax, we are after the expenses that they have done, they have do what? Pay. Aside that, expenses that is reasonable, necessary, exclusive. So, for foreign exchange loss. Foreign exchange loss provision is a disallowable expenses, but realized foreign exchange loss that you have made the foreign exchange loss is an actual loss. They just make provision that they propose that they make a loss. They have not actually made the loss. That is the reason why we disallow it. Assuming they have actually made that foreign exchange loss, we were told like that, we are going to allow it. So, on the solution, add the depreciation is a disallowable expenses. Loss of sale of fixed assets. So for depreciation for Nigeria is 7.2 million. For Ghana, 2.9 million. For the total, 10,100,000. For Ghana, 620. For the total, 620. Foreign exchange we have for Nigeria, we don't have for Ghana. The total 1 million. You know, we want to compute adjusted profits. It's allowable expenses, and you are going to less what? What are you going to less? Non-taxable income. If you are asked to compute adjusted profit, you add disallowable expenses and less non-taxable what? Income. Now, additional information give us that other income, look at the other income of the country, of the business. For Nigeria, the other income is 1.2. For Ghana, 800,000. So, additional information is now telling us that other income of that 1.2, the one of Nigeria, is profit from sale of non-current assets. Is it taxable or non-taxable?
It's not taxable.
Profit on sale of non-current assets. Is it taxable
It's
or
not
non-taxable?
taxable.
It's
Non-taxable because it's already subjected to capital gains tax.
Because it has been subjected to capital gain tax. So we less it in getting adjusted profit. Gain from disposal of security. Gain from disposal of security. Gain from disposal of security too will have been subjected to capital gain tax. So it is not taxable. So in computing our solution, add disallowable expenses, less non-taxable income. The two non-taxable income, the two income, profit on sale of fixed asset, gain on disposal of security, you can see them, I bracket them and lessen them. I'm lessening them. So I'm lessening them. So for the Nigeria, our adjusted profit is 21,800,000. For Ghana, our adjusted profit is 9,380,000. For the total is 31,180,000. So after getting your adjusted profit, you now ask, before this income, this adjusted profit can be subjected to tax, there is some relief I need to give before adjusted profit can be subjected to tax. What relief are we going to deduct from adjusted profit before adjusted profit will be subjected to tax? What relief or allowance are we going to deduct from adjusted profit?
Capital allowance.
Capital allowance. Capital allowance. So we were giving capital allowance for the two countries. The one of Ghana is 5.1 million. Capital allowance for Nigeria is what? 8.8 million. So I'm going to less capital allowance from adjusted profits. If I remove capital allowance for the Nigeria, 8.8 million from the adjusted profit, I will get a total profit or taxable profit of 13 million. If I remove capital allowance of Ghana, 5.1 million from its adjusted profit, I will get a total profit or taxable profit of 4,280,000. At the end of the day, for both operations, their total profit is 17,280,000. I will now compute tax liability. When I want to compute tax liability, it is only on the total it is only on the side of the total, all the total I'm going to compute tax liability on. I'm not going to compute tax liability for Nigeria separate, for Ghana separate. It's only on the total. Now, my tax liability. The first type of tax that the company will pay is company income tax. My company income tax is going to be at the rate of total profit. And my company income tax is 17,280,000 at 20%. The rate I use for my company income tax, I use 20%. Why did I use 20%? Why? Who can tell me why I use 20%?
Because it's a small company now. The profit is below 25 million naira.
Is it the profit?
Yes, sir.
No.
The revenue.
No.
The revenue.
The
It's a
revenue.
medium company.
If you go to the question at the beginning, if you look at the total revenue, 83 million. Even the gross fee, 81 million. Because the 2 million is disallowed. It's 81 million you are going to use to dodge. It's less than 100 million. That is the reason why I use 20%. Assuming it's more than 100 million, what percentage am I going to use?
30%.
30%. Thank you very much. So, 20% of the total profit of 17,280,000. My company income tax is 3,456,000. Out of this company income tax, for the total operation, both Ghana operation and Nigeria operation, they're supposed to pay company income tax of 3,456,000. I will now ask myself, the Ghana operation, they have paid tax in Ghana. Since they have paid tax in Ghana, I will give them relief. I will give them relief because they have paid tax in Ghana on their profit. The company income tax that they're supposed to pay in Nigeria is 343,456,000. But they will not pay this because on the total profit that will compute this company income tax, Ghana profit is there. And Ghana profit, they have already paid tax in Ghana in the country of Ghana. On that, their profit realized in Ghana. My double tax relief. Since in the question, there is no agreement between Ghana government and Nigeria government, we are not giving any rates. We are going to compute what are we going to compute? Commonwealth rates to determine the double taxation relief. You can still remember resident company. We said when there is no agreement, we will compute Commonwealth rate. We now compare the Commonwealth rate with half of Nigeria tax rate. Now, let's go and compute double tax relief for Ghana. Ghana operation. Let's go and compute the double tax relief. How can I get my double taxation relief? My double taxation relief shall be A, half of Nigeria tax rate. Half of Nigeria tax rate. Whose income is going to be affected by double taxation? Which tax is going to be affected by double tax? Only company income tax. And half of the rate of company income tax that we use in this question is 20%. Half of 20% is what? 10%. I will compare it with Commonwealth rate. How do I compute my Commonwealth rate? Foreign tax paid all over total profit or taxable profit of foreign operation. How much tax does this company paid in Ghana? Are we giving the tax that this company paid in Ghana? How much? How much?
2,400,000.
2,400,000 was paid to Ghana Tax Authority. That is the foreign tax paid. The total profit of the foreign operation will be how much? What is the total profit of Ghana business? Which is the taxable profit? Is 4,280,000. So if I want to compute my Commonwealth rate, foreign tax paid 2,400,000 all over what? Total profit of the foreign operation 4,280,000. I will get 56%. And according to the law, they said lower of half of Nigeria tax rate and Commonwealth rate. Half of Nigeria tax rate, I will compare it with Commonwealth rate. The one that is lower is what I'm going to use as double tax relief rate. Which one is lower among the two? Which one is lower?
Half of Nigerian tax rate.
Nigerian tax rate.
Half of Nigeria tax rate. So after I compute my CIT for the total operation, I will now say less double taxation relief. My double taxation relief will be rate is half of Nigeria tax rate, 10%. I will now ask myself, out of this total profit of 17,280,000, which one of them want to suffer double tax? Out of 17,280,000, how much from 17,280,000 want to suffer double tax? Only the Ghana operation. You know how we get this 17,280,000? We had total profit of Nigeria and total profit of Ghana. Abi, it is only the Ghana operation want to suffer double tax. I will now say 10% of my double taxation relief amount will be 10% of Ghana total profit. The double taxation relief rate times the total profit of the foreign operation, foreign branch. Ghana is the foreign branch. The total profit of it, 10% of it. My double taxation relief amount will be 428,000. They're supposed to pay company income tax of 3,456,000. Then we are going to give them a double tax relief, a discount of 428,000. The net CIT that they will pay is going to be 3,028,000. 3 million what? 28,000. Do we understand? Do we understand? Now, I've get my next CIT. I will now complete my education tax. My education tax is going to be 3% of adjusted profit. How much is the total adjusted profit? Both Nigeria and Ghana. The total adjusted profit is 31,180,000. So 3% of it. Because education tax is computed on adjusted profit. So my education tax is now going to be 935,000. 935,000 for 400 naira. Any question, any query on this? Any question, any query? Any observation? Let's look at another one. Let's look at another one. Let's look at another one, which is question 3. Question 3. Question 3. Question 3. Seedland Nigeria Limited is a Nigeria company that has been operating as a manufacturing company for several years. in Nigeria. The company is into manufacturing of varieties of drinks. As a result of excellent performance in the past, the company acquired another company that was into cultivation of what? Into cultivation of its major raw materials, such as orange, mango, pineapple, apple, and banana. The company was able to achieve its inorganic growth strategy after the acquisition. Meanwhile, as a result of unfavorable business climate and high cost of production in Nigeria, the management of the company decided to establish what? A branch in Canada. After receiving a visibility study report from appointed business reorganization consultant, from appointed business reorganization experts, Major Touch Consulting Incorporation, Incorporation. Seedline Limited filed its corporate tax for the year for 2022 year of assessment based on its results for the year ended December 31st, 2021. The recent desk examination conducted by Federal Inland Revenue Service on the 2022 year of assessment corporation corporate tax return filed by Seedline Nigeria Limited reveals some gap. During the reconciliation meeting with FRS, there was an argument between FRS official and the management of Seedline Nigeria Limited on the correct assessment of profit made by what? Seedline Incorporation, which is their branch. The managing director of Seedline Nigeria Limited is of the opinion that the tax paid by Seedline Incorporation in Nigeria should be the final tax. But that the tax paid by Seedline Incorporation in Canada should be the final tax, since the company is only an overseas branch. It further submits that provision of Company and Allied Matter Act 2020 only applicable to a company incorporated in Nigeria. The managing director was furious when company received a reminder of notice of assessment from FRS and has therefore threatened to approach Tax Appeal Tribunal for redress. you have been engaged by company as a tax consultant to provide professional advice on the tax implication of the profit made by Sigland Incorporation and possible representation of the tax appeal tribunal sitting. The statement of profit or loss for the year ended December 2021 of both operations after result of Sigland Incorporation have been converted to Naira at prevailing exchange rates, and other relevant documents was handed over to you by the MD, by the managing director. The extract of the profit or loss of the two corporate entities reveal the following. Sigland Nigeria Limited, Sigland Incorporation. We are given this. Total expenses, net profit. You are provided with the additional information. Repair and maintenance made up of the following: repair of official vehicle, construction of additional office space, purchase of printer toner, detail of administrative expenses, stamp duties on increase in share capital, value added tax on administrative expenses, penalty for late filing of payee tax return, audit fee. Donation is made up of this following: donation to club, donation to COVID-19 victim fund. The capital allowance for Sigland Nigeria Limited in respect of plant and equipment and other qualified capital expenditure as agreed with the tax authority was 33 million naira. The capital allowance of 44 million naira claimable by Sigland Incorporation on qualified assets was certified by the tax authority. The Canada tax authority, the Canada tax rate is assumed to be what? 35%. Required, advise the management of Sigland Nigeria Limited on the tax implication of overseas branch. B, compute the tax liability of the company in line with your submission in A above. The first question is, we are asked to advise the company on the tax implication of an overseas branch. What this one means is that if a Nigeria company has a branch in another country, that branch is called overseas branch. What is the tax implication of overseas branch? The provision of Company Income Tax Act 2004 as amended on profit of an overseas branch of a Nigeria company is that such profit of overseas branch is deemed to derive in where? In Nigeria. And is therefore liable to tax in Nigeria. What we are saying is tax implication of overseas branch. You need to let them know that if a company that is registered in Nigeria has a branch in another country, the profit of his branch in another country will be liable to tax in Nigeria. We assume that that profit is derived in Nigeria and that profit will be liable to tax in Nigeria. Any foreign tax suffered in overseas is not allowed in determining the overseas profits. Assets used in such branches will be entitled to claim capital allowance. What this one is saying is that overseas branch, their qualified capital expenditure, their asset that is not in Nigeria, they can compute capital allowance on it and we deduct the capital allowance. You can see that the first illustration we did, that Ghana branch, they have capital allowance and we deduct it. You know, that capital allowance that we deduct, the asset that they compute the capital allowance on is not in Nigeria, it's in Ghana. But despite that, they claim the capital allowance. Loss incurred from such branch can be set off against profit in Nigeria. What this one is saying is, assuming that first illustration we did, let's go back to the first illustration. In that first illustration, you can see that we have adjusted profit in Nigeria operation. Assuming when we compute the one of Ghana, it now results into adjusted loss. That loss, we can use it as a relief against the profit. So, as is loss, we can minus it from 21,800,000 so that the total we are going to have, instead of having 31,180,000, we will have less than that. It's allowed. That is what they are saying in this one, that they said loss incurred from such branch can be set off against profit in Nigeria, provided that the loss incurred is from the same source. What they are saying is, provided that the branches that they have in other countries, the business that they are doing in their branches is the same as the business that they are doing in Nigeria. And double taxation relief is available on the profit of the overseas branch. Double taxation relief is available on that profit of overseas branch. When we compute tax liability, we will compute double tax relief. So that the tax implication of overseas branch. These are the tax implication of overseas branch. So, being part of the question, we are asked to compute tax liability for the company. We will do it the same approach we do the first one. We will start with our net profit. Sidlon Nigeria Limited is the Nigeria company, is the head office. Sidlon Incorporation is the one in the Canada, is the branch. And we have the total. We start with our net profit. Net profit is given. We add disallowable expenses We had what? Disallowable. Let's go and look at the expenses. Which expenses out of all these expenses, which one is disallowed among them? Which one is disallowed? Number one expenses that is disallowed. Loss or revaluation of non-current assets. They revalue non-current assets, they now loss. They add it as an expenses. It's a disallowed under the tax law. Impairment of an asset, impairment charges, loss or revaluation, all those your things that you are doing in your corporate reporting in tax is disallowed. They are just like a depreciation. When you see impairment in an expenses, you disallow it. Loss or revaluation of non-current asset, loss or revaluation of fixed asset is disallowed. Because in tax, we normally ask ourselves a question: who do you pay the loss? When you revalue your fixed assets, you now make a loss. Who do you pay? You do not pay anybody. So by virtue of that, is disallowable. Impairment too is disallowable. Mind you, since loss on revaluation of non-current assets is disallowed, gain on revaluation of non-current assets, how do we treat it? Gain on revaluation of non-current assets, how do we treat it? The loss on revaluation of non-current asset is a disallowable expenses. The gain, if it is gain, we have, you know, the gain will be added as an income. That income, if we are putting liability, how do we?
We can hear you, sir.
I'm thinking that that income is capital in nature. So if it's going to even be taxed, it should be capital gains tax.
No. Gain on revaluation of non-current asset is not capital gain tax. Since loss of revaluation of non-current asset is a disallowable expenses, the gain on revaluation of non-current assets too will be treated as a non-taxable income. Do you understand what I mean? The gain too will not be subjected to tax, since they did not allow you to deduct the expenses to reduce your tax liability. The gain too cannot be allowed to added as an income, so the gain will be treated as non-taxable income. Do you understand what I mean? So go back to this question. Loss on revaluation of non-current asset is a disallowable expenses. Depreciation is a disallowable expenses. Aside that, we are not giving some additional information. Income tax paid in Canada, they pay tax in Canada, they not use as an expenses. We disallow that too. We disallow that. So let's go to the solution. My first disallowable expenses, like I said, loss on revaluation of non-current assets. My second disallowable expenses, depreciation. The third disallowable expenses, income tax. That is the reason why we add it as a disallowable expense in additional notes. Now, aside that, we have some breakdown of expenses given to us. Administrative expenses, these administrative expenses, we are given the breakdown in the additional information. Part of these administrative expenses, part of them is disallowed. It depends on the breakdown. Let's go and look at the breakdown of administrative expenses. Let's go and look at the breakdown. Let's go and look at the breakdown of administrative expenses. Look at the breakdown of administrative expenses. They say administrative expenses are as follows. Number one, stamp duties on increase in share capital. Number two, value-added tax on administrative expenses. Number three, penalty for late filing of return, late filing of payee tax return. Number four, audit fee. Out of all these expenses, which one is allowed, which one is disallowed? Stamp duties in increase in share capital is capital in nature, and it's another type of tax. Is disallowed. Value-added tax too on administrative expenses. Since the value-added taxes on administrative expenses is not on non-current assets, the value-added tax is allowed. Penalties is disallowed. So out of this, stamp duties and penalties, they are the disallowable expenses. So we add it as part of our disallowable expenses. Stamp duties and penalties. Repair and maintenance too, we are giving the breakdown. For the repair and maintenance, under the repair and maintenance, we have repair of official vehicle, construction of additional office space, purchase of printer, toner. Out of these three expenses I mentioned, that comprises of repair and maintenance, which one is allowed, which one is disallowed? Who can tell me which one is allowed, which one is disallowed?
Construction of additional.
Repair. Okay, I'm listening.
Then the rest are allowed.
The rest is allowed. Construction of additional office space is disallowed. Why?
Capital in nature, it's meant to be capitalized.
Because it's capital in nature. Why the rest is allowed? Do we understand? Let's go to donation. We are giving the breakdown of donation. We are giving the breakdown of donation. Look at the breakdown of donation. Donation to club. Donation to COVID-19 victim fund. Which one is allowed? Which one is disallowed? Is both allowed? Is both disallowed? Oh yeah, now. Donation to club is not allowed. But when you donate to COVID-19 victim fund is allowed. Donation to club is disallowed. If you donate to Rotary Club, Lion Club, Ikeja Club, they are disallowed. It's not allowed for tax purpose. The only donation that is allowed when you donate to government institution or you donate to a relief fund. Example of relief fund, COVID-19 victim fund. So when you look at the solution, you add construction of additional office space is a disallowable expenses. You add it back. Stamp duties on increase in share capital is a disallowable expenses. You add it back. Penalties for late filing is a disallowable expenses. You add it back. Donation to club, you add it back. At the end of the day, you get adjusted profit for Nigeria operation. The adjusted profit for Nigeria operation is 804,418. Why the adjusted profit for Ghana, for Canada branch is 993,240 naira. At the end of the day, the total adjusted profit is going to be 1,797,658. From your adjusted profit, you now less your what? Capital allowance. You less your what? Capital allowance. We have capital allowance for Nigeria operation. We have capital allowance for Ghana, for the Canada, sorry. You less them, you get your taxable profit or total profit. In some question, they will give you combined capital allowance. They will say capital allowance for the company is so amount. In that case, you will not use that capital allowance for both Nigeria or both the overseas branch. You go and use it in total only. In some question, they will not give you that this capital allowance is for Ghana, is for Nigeria operation unit. This capital allowance is for our overseas operation unit. They will just say the capital allowance for the company is also so amount. In that case, you will not use capital allowance for any of the operation. You go and just use it in the total area. You go and use it in the total, under the total. But in this question, we are giving capital allowance for the Nigeria operation and we are giving capital allowance for the Ghana. We less it from the adjusted profit. We add them together. At the end of the day, we get total profit. When you get your total profit or taxable profit, you will now compute your tax liability. Your tax liability is going to be based on the total, only this. My tax liability, company income tax, I use 30% because the revenue is more than 100 million in this case. The revenue is more than 100 million because the question is in thousands. So my company income tax, 30% of the total profit, 30% of 1,720,658. I'm going to get 516,197. I will now compute my double tax relief rate. If I want to compute my double tax relief rate, half of Nigeria tax rate, the company income tax I use in this case is 30%. Half of it is 20%. Commonwealth rate, I will not compute my Commonwealth rate since I was given Canada tax rate. In the question, they said Canada tax rate is assumed to be 35%. It means I was given Canada tax rate. I don't need to compute Commonwealth rate again. That Canada tax rate will be used as Commonwealth rate. So I will compare it with half of Nigeria tax rate. Since half of Nigeria tax rate is less than Canada tax rate, my double tax relief rate is going to be half of Nigeria tax rate. So my double tax relief rate is going to be 15% off out of this income of out of 1,720,658. Which one want to suffer double tax? It's only 949,240 that want to suffer double tax. So my double tax relief amount is going to be 15% of 949,240, which I'm going to get 142,386. Once I get that, I will less it from the company income tax I get. So my net company income tax payable is going to be 373,811. My education tax, I use 2.5% because as at this period, 2022 year of assessment, education tax rate is 2.5%. So my education tax is going to be 2.5% of the total adjusted profit, which is 1,797,658. So that is how I get my education tax. Any question, any query, any issue? Any question, any query?
Sorry,
Do
sir.
we have any
The
question?
education tax. I have a question, sir.
Okay.
Hello. The education
Yeah, I can
tax,
hear
are we
you.
not supposed to use the normal 3%? Are we not supposed to use what the Finance Act said, the 3%? Is it that during the exam, if the date is backwards, we need to work with the date as at then,
In
not the
your exam
present
booklet,
percentage?
in your exam booklet, they will give you that education tax from so date is 2%, from so date is 3%, from so date is 2.5%. As a 2022 year of assessment, education tax is 2.5%, my sister. They will state it at the back of the exam booklet. Hope you understand what I said.
Yes, sir.
Okay. So any other query from this? You can see that in this question, we did not compute double tax Commonwealth rates because we are giving Canada tax rate. In that case, we assume Nigeria has double tax agreement with Canada. We now compare it with half of Nigeria tax rate. But unlike the first one we did, we compute Commonwealth rate, foreign tax paid all over total profit of the foreign operation. So any query, any issue?